FY23. And I do want to again share that Max Life share in Axis Bank counter is maintained since January of 22. So we have not lost any incremental counter. We are maintaining on average, plus minus 1% is where we are. Product innovation front was also very important, and that's one of the core reasons why our margin looks a bit promising compared to last year as well as first quarter. It remained balanced with PAR being 19%, non-PAR savings at 36%, ULIP at 38%, and protection at 8% on individual APE basis in the first half of the year. Max Life has successfully created new product categories in online savings, homemaker segment, NRI, self-employed, and has accelerated product innovation agenda. The culmination of all this has led to increasing profitable product mix and resulted into a margin expansion of 140 bps year on year. In line with our strategy to focus on retirement business, we have commenced business in our wholly owned subsidiary, Max Life Pension Fund Management. This has strengthened our existing retirement offering comprising of annuity and smart wealth long-term income savings plans. We now cater to customers at each of their life stages, when they are accumulating funds for retiring, planning for retirement, and also post-retirement. We also have enhanced our annuity offering with flexibility of premium payment term as well as extended entry ages to broad-based new customers. This led to a growth of 86% in annuity business in first half of FY23. Retail protection, which has been a matter of discussion over the last few quarters, also saw an uptake and grew by 11% in quarter two and witnessed 22% sequential growth from quarter one to quarter two as we forayed into new segment of self-employed individuals to buy protection with launch of 2 new plans, Smart, Secure, Easy Solutions with 4 pre-packaged solutions and frictionless onboarding, Smart Flexi Protection Solution, which is an investment cum protection solution launched for primarily self-employed segments with smooth onboarding. This bounce back of protection growth and entry into new segments further strengthens our belief in the long-term opportunity of protection business. With an objective of increasing penetration in online savings market, a Smart Fixed Return Digital Plan has been has seen huge positive uptake in building the savings category on both website and web aggregator space. Talking about customers and our commitment to them, at Max Life, customer satisfaction is an organizational priority. It's a part of management goal sheet, and our best-in-class claim paid ratio of 99.34 is a testimony of our focus towards customer obsession. The first half of FY23, 13th month persistency of regular limited pay premium was 84% and 61st month persistency at 50%, which is more or less stable. Happy to share that in quarter one of the current financial year, Max Life 13th month persistency ranked number 1 in number of policy days. Performance on customer experience is also measured through a globally established metric called Net Promoter Score. During the first half of the year, we witnessed an improvement of 2 points from 49 in March 22 to 51 in September 22 in the overall company NPS scores. Max Life also bagged Best Customer Initiative and Best Use of Relationship Marketing at the Customer Fest Awards in for 2022. And the last one, which is our commitment to digitize this organization for efficiency and intelligence. In FY23 first half, we have strengthened our underwriting practices with an industry-first launch of in-house underwriting AI model called Medicheck for fraud prevention. The objective is to curb diagnostic center-related frauds through an in-house intelligence model. This model has helped us delist 388 medical centers in September where we suspected fraudulent activity. In e-commerce, we launched multiple initiatives, including new age do-it-yourself saving journey with enhanced customer experience leading to improvement in lead to quote by 80%, and WhatsApp bot journey enabling 63% query resolutions and improvements in user engagement. M-Smart, which is a sales management and activity monitoring tool, was launched for Axis and APC channels. As I have shared in my previous conversations, we are on a rapid journey to fully digitize our sales management processes, and this year has seen very active work in that area. And Axis and APC are two channels that got done last quarter, which will enable better activity traction, leading to increased conversion. QR code launch for customer servicing. This will enable frictionless do-it-yourself digital transactions. Our digital capability has proved the testimony of agility in integration of technology with new partners, as we took less than a week's time in onboarding 3 brokers and 1 new banker partner. We also launched our pension fund management business with digital-first approach, as treasury systems, website, and finance systems are hosted on cloud. To summarize, there is very active work taking place in all the strategic areas, and I'm going to just hand it over to Amrit Singh to talk about the financial outcomes from the first half of FY23.
Thank you, Prashant. So moving on to key financial metrics. On the consolidated basis for MFSL, the revenue excluding investment income stands at rupees 9,720 crores, a growth of 12% in H1 FY23. The consolidated profit after tax is at rupees 130 crores, up by 56%, largely due to lower tax expenses in the corresponding period. Renewal premium grew by 14% to rupees 6,526 crores for Max Life, and gross premium grew by 12% to rupees 9,904 crores. Value of new business stands at 586 crores versus 546 crores in the previous year, representing a growth of 7%. The NBMs have improved from 25.3% to 26.7% in H1 FY23. Embedded value as on September 30th, 2022 stands at 14,704 crores. Operating ROE or H1 FY23 on annualized basis is at 15.7. Policyholder OPEX to JWP ratio improved to 15.1 from 15.5% last year. H1 FY23 profit before tax is rupees 144 crores, a decline of 3% year on year. Profit after tax is rupees 123 crores for Max Life Insurance. Solvency of Max Life Insurance stands at stable at 196%, and overall assets under management at end of 30th September 2022 were around 1.13 lakh crores, a growth of 13% year on year. Lastly, before I hand over to the moderator for Q&A, as you would be aware that recently in relation to the transaction involving Axis Bank and Max Financial Services Limited with respect to transfer of shares of Max Life, which were all duly approved by the board and shareholders of Max Life and MFSL, IRDAI, via an order, has issued a penalty aggregating to rupees 3 crores for alleging non-compliance on certain items, terms of its approvals granted. With a way to pay the way forward for the future, including strengthening the long-term strategic partnership with Axis Bank and avoiding unnecessary and long legal escalations, Max Life has paid the penalty imposed by IRDAI, while it is a belief of not committing any wrongdoing. Given the discussions are currently underway with the regulator on the above-mentioned transactions, including the MSI transactions, we will request you to refrain from questions on this matter and keep your questions within the scope of operating performance. On behalf of our JV partner Axis Bank, we would like to indicate that Axis Bank is committed to its long-term association with Max Life as its promoter and bancassurance partner. So in summary, to conclude, we remain committed to our purpose of inspiring people to increase value of their lives and work across all possible areas of business to make it happen. We are now happy to take any questions that you may have, and I will now hand over to the moderator to open the floor for Q&A.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Avinash Singh from Emkay Global. Please go ahead.
Yeah, hi. Good morning. The first question is on growth. I mean, the base numbers and the current macro reality, also the individual channel dynamics. In this backdrop, can you provide some sort of a guidance for how the growth is going to look in H2? Particularly, I'm coming that your last year Q3 was also very, very strong because you had some kind of a good offtake of ULIP products. So, I mean, balancing all these factors, how do you see growth in H2? So that is my first question. And the second question would be on embedded value. If you can provide some color on what has been the amount of, investment and economic variance. Probably, I mean, that of course that would have had some negative impact. So what the extent of that? Thank you. These are my two questions.
Good morning, Amdanji. Always great to hear from you. Let me answer the first question. If you look at our performance, any performance is a combination of the internal issues as well as external macroeconomic issues. Firstly, talking about internal issues, we've been updating you that we are going through a process of open architecture on both our bank counters. I'm very hopeful that through the second half of the year, some of those internal issues will get resolved as the base settles in, which will be a positive thing for Max Life Insurance. However, you highlight pertinent issues with respect to macroeconomic challenges, and we have seen that in the second quarter, the industry has grown much slower than how the first quarter was. In view of that, at this point in time, giving a guidance or forecast is going to be quite difficult for me. However, I will say we will do the best that we can. I'm very optimistic that with all the initiatives that we've taken in our own channel, proprietary channel, the investments that we're making to build distribution capabilities with new sign-ups that we've done with banks as well as brokers, as well as the effect of open architecture stabilizing and settling. I'm optimistic that second quarter we will do as best as possible.
The second question, I think, Avinash, you asked on the non-operating variance in the EV. That is a negative of 545 crores, largely because of the interest rate movements. A bulk of it is, around 502 crores is because of interest rate movements, which you are aware it's transitory in nature because generally our portfolio is all hold to maturity.
Yeah. Okay. Thanks. Thank you.
Thank you. The next question is from the line of Yash Jain from Sunrise Capital. Please go ahead.
Hello.
Yes.
Good morning, gentlemen. I just wanted to understand something. Not taking questions on the transaction, how fair do you think it is in the conference call, since it's a meaningful deal for both Axis Bank and Max Life? I'll still have two questions on the transaction. The management can choose not to have them and not answer. But my first question is, with respect to the transaction, there was a report yesterday which suggested that the regulator may look at only allowing the balance 7% acquisition at a fair market value and a uniform price, which the understanding, of course, is that will be much higher. My question to the management is that is the management in talks with Axis Bank on arriving at a fair market value, and is Axis Bank ready to buy that stake at a fair market value? If not, then what happens to this transaction? And the second thing, can the management please explain the recent 8 transactions that have happened, except for the 3 transactions which happened with Axis Bank? They have happened at price points per share which are far from each other. In fact, 15 days ago, before the main transaction, the transaction happened at 166 rupees, then straight away went down to 31 rupees. why should it not be open to investigation and assessment from various regulators, including SEBI?
Yes, while thank you for your question, and I do appreciate the question. Max Financial Services and Axis Bank are listed companies, and anything which is worth disclosure, which is material information to investors, we will absolutely disclose as soon as it comes to our notice. At this point of time, we have no communication from the regulator around any valuation recommendation or guidance. So, hence we are staying away from any disclosures, number one. Number two, Max Financial Services is an unlisted company, and Max Life Insurance is an unlisted company, and Max Financial Services is the owner. There are several valuation methodologies recommended, and all the valuations which were done were as per the legally permissible valuation techniques. So while I do appreciate the question that you ask, it is a transaction which has happened in a private company between two shareholders, and all the valuation methodologies which were used were as per approved legal valuation techniques. So I hear you, I understand you, but at the same time, let the other regulators decide. Let the overall ecosystem decide rather than we being judgmental about the valuation methodology.
Just one clarification. The regulator's order does mention that, the necessary changes which the regulator thinks are not the previous transactions, not at a fair market value and uniform price, the necessary changes should be incorporated in future transactions. Should that not be interpreted as that whatever happens, even the balance part of the deal, that is 7%, the necessary wrongdoings will have to be corrected and will have to be implemented?
I think the words that you use here, again, have a bit of judgment in it. The wrongdoings, we have gone public to communicate to everybody that we don't believe that there is a wrongdoing, but at the same time, we want to move forward with the transaction, and hence we have paid the penalty. There could be several interpretations, and then we, let the process get followed. The process is we are waiting for the MSI approval. Subsequently, we will apply for the 7%, share transfer, in which case we will see what the regulator has to say. At this point in time, both Axis Bank and Max Financial Services, Max Life, we remain committed. Axis Bank has reaffirmed their commitment to being the promoter as well as distribution partner for Max Life Insurance. Let's leave it at that level, and as I mentioned to you, both the companies are listed companies. If there is any information which is worth investors' information, they will promptly come back and inform.
Sorry to interrupt. May I request Mr. Jain to please rejoin the queue? We have participants waiting for the turn.
Okay, appreciate.
Thank you. The next question is from the line of Sahej Mittal from HDFC Securities. Please go ahead.
Hi, good morning, everyone. Am I audible?
Mr. Mittal, can you please speak a little louder?
Yeah, now is it better?
Yes, please go ahead.
Hi, good morning, everyone. So a couple of questions from my side, sir. So firstly, if you can comment on the sharp increase in the non-par savings in the mix to about 36-37%, right? So how sustainable do you think is this? Because even in the last year, we saw that the share of non-par savings shot up in one quarter and then again mean revert to 25-26% levels. So if you can talk about the on-ground demand in terms of the non-par savings, and how do the margins look like on the new short-term savings product which we have launched? And I missed on the growth bit on this product. And also for Max, retail protection has grown quite well, which is contrary to the industry trend. So what is sort of driving this? And are we still maintaining our guidance on the 26-27% VNB margins for FY23-24? Are we recalibrating this number? And fourthly, on the wallet share in the Axis Bank channel, how does Max Life's share look like in the Axis Bank wallet right now? And where are we in terms of the sales percent deployment in the Axis Bank channel? If you can comment on these questions. Thanks.
So you asked 4 questions. The first one I think is on non-par mix, the stability. As you rightly pointed out that for the quarter we have seen the mix improve, and it's very similar to how it was for last year. And where is this mix improvement coming from in overall non-par category is also success that we are experiencing on the annuity side. Our annuity business has grown 86% for the first half. That is also sitting in the non-par line as well. And with respect to how on the ground things look like for future quarters, I think the non-par mix is holding fairly steady and stable. Again, you're pointing out as last year quarter 3 was very high in ULIPs. As we have entered this particular quarter, the non-par mix is actually far more steadier as it was in this quarter 2. And we're quite hopeful that it will remain steady in these lines, and we will continue enabling this particular product category. The second question you asked was on protection. As you rightly pointed out, we have experienced growth of protection of around 11% for the quarter, 11-12% for the quarter. Though this is still quite less as compared to how we would have anticipated and expected, but and largely because of some bit of demand moderation after COVID fear actually abating in the consumer's mind. But in our assessment, protection is a long-term opportunity. There is severe under-penetration. And as both the life insurers and reinsurers also start easing out supply-side constraints, we will see the momentum kind of start building up. So we continue to remain positive on protection. I think for us, it's an important category. We have ensured that we are focusing on it all across all channels. So that is what has helped us drive this particular growth number. The third question you had was on the short-term digital plan that we have launched with very attractive rates. It's a good shareholder IRR product. It might be a bit lower from a margin profile perspective, but overall it's part of our portfolio strategy, wherein we will continue driving that particular product form for more millennials and more savvy consumers, offering this kind of rates of guarantees. The last question you asked was on OA share. As Prashant mentioned, the OA share has remained stable since January, and why January is important is because that's when the open architecture is completely scaled up at Axis Bank. We have remained stable in the ranges of 69 to 70%, and that's the level that we are today at.
Right. And where are we in terms of the sales percent deployment in the Axis Bank channel? Are we done with it, or how is it looking right now?
So we are over-investing and investing ahead of time with respect to manpower. We are ramping up as we had planned, and we will continue doing so because the moment the business volume starts growing, the benefit of that will get amplified towards that. So we are on that trajectory.
Could you quantify the number of the sales person we have right now in the Axis Bank channel as of date?
It's around near about 6,000 is the levels of frontline sales team members that we have.
And this compared to our competitor in the Axis Bank channel would be?
So I won't have their specific details. We are higher than them, and our deployment is actually on schedule and on plan.
Right. And sir, just one clarification on the non-par savings side. So how should we look at the full year number in terms of the business mix from non-par savings?
So we would like it to remain in this range bound that you are seeing at this point in time, and you should see that actually also pan out in the full year basis.
Okay. Thanks for that, sir. I'll join back in the queue.
Thank you. The next question is from the line of Manoj Baheti from Carnelian Capital. Please go ahead.
Hi. Good morning. Am I audible?
Yes, you are.
Yeah. So, Prashant, a couple of questions. In fact, first is that the way we have given away in Axis some of our market share, I understand with open architecture and a new entry. But my question is that what gives us confidence that our wallet share in Axis will remain at 70? The way initially your competitor has gained some market share from you, it may continue. So, is there anything which gives you a confidence that your wallet share in Axis will remain at 70%? So that is my first question. I have a couple of more questions once you answer this, or shall I put all my questions together?
Yes, please go ahead.
Yeah. So my second question is, along with this, if you can also touch upon the new partnership agreement which you have done with leading broker as well as with Tamil Nadu Mercantile Bank. So if you can just give us update how you are seeing this partnership helping you going ahead. And lastly, if you can give us update on stake purchase or the swap with Sumitomo, which we have filed with the regulator, but I think that thing because of some changes, changes in INDA, it was getting. These are my questions. Thank you.
Thank you very much. Let me first talk about the open architecture. It's very common that an open architecture gets implemented, the incumbent loses anywhere between 30 to 40% of the counter share. In our case, we lost about close to 28%, 28 to 30%, as the full-blown open architecture comes in being. While I do appreciate your question, but it is very, very common. It is very hard to retain 80-90% of counter share with a full-blown open architecture. What gives me the confidence that we will be able to maintain or grow is the confidence of last 9 months. The last 9 months, our counter share has remained at the same level, more or less, and there are attempts, of course, made. It's a competitive play there. The attempts made to keep it the same level or grow. However, the experience of last 9 months gives me the confidence that we will be able to maintain that or take it forward. On your second question on new partnerships, yes, any banker relationship in the context of life insurance is very important, and we were very happy that we were able to get into a relationship with Tamil Nadu Mercantile Bank. It has very strong presence, especially in Tamil Nadu, and we were a reputed bank with a very loyal customer franchise, and I'm very hopeful that when we launch it, we will have reasonable success. So this is an open architecture counter again, and the new partner, the name of which we'll disclose at the right time, will also be an open architecture counter. These are compared to Axis Bank or Yes Bank, there will be smaller counters. But the approach that we're taking is to increase our bouquet of bank assurance relationships. I will assume that both these will add to the distribution muscle that we are trying to build. On the third question that you asked about swap with Sumitomo, yes, I'm very, very hopeful that in reasonably near future we should have the approval. We are yet to hear from IRDAI on that one, but like we stated in our disclosures, that in view of moving forward with the series of transactions which are expected to happen first with NSI and then with Axis Bank, we've gone ahead and paid the penalty. So I'm sincerely hoping that in near future we will have the approval.
Just one small question I have. We have got now Max Life Pension Fund Management. Earlier, I think this part was missing in our bouquet. If you can touch upon how you see this is going to help you in terms of growing your business, and if you can touch upon the strategy on that side, that will be helpful. Thank you.
We have, since last year, we have been articulating that two areas are very important for us, and we believe that those segments have the potential to become really large. One of them is retirement, and the other one is health, protection, and well-being. And in both areas, we are taking solid steps, and setting up the pension fund management business was a step in that direction. We have sharp focus on all solutions pertaining to retirement. So in our own business, we have a lot of focus on trying to drive annuity to some extent. Even the non-par portfolio that we have, especially the income-based solutions, target the retired segment or retiring segment. We have just launched another product within the annuity space. So while on one side we are trying to enrich our product portfolio with very competing product solutions, we are also trying to be sharply added to the ecosystem of retirement, and NPS is one of them. With a view of that, we are setting up, or we have set up a pension fund management business. In addition, Max Life Insurance is an annuity service provider, which is another license, and we have also applied for the POP license so that we can become a full suite provider in the NPS space. So there are series of activities that we're doing. Of course, it's a long-term play, but one is trying to penetrate deeper into the retirement solutions and the ecosystem to make sure that we remain a dominant player and we become a part of the retirement business as this particular segment evolves and grows with time, where we have a very high level of belief.
Thank you. Wish you all the best.
Thank you. The next question is from the line of Adarsh from CLSA. Please go ahead.
Hi, Prashant. Question is on the higher guarantee.
Adarsh, I'm so sorry, but we cannot hear you.
I hope this is better.
You are sounding from a distance, actually.
Let me try this, otherwise I'll come back. So I was asking, in terms of the higher guaranteed product, what part of the non-par sales is that now? The 7% plus guarantees?
Others, we can barely hear you actually. Very sorry.
Okay, let me just come back, or I'll take it.
Yeah, okay.
Thank you. The next question is from the line of Madhukar Ladha from Elara Capital. Please go ahead.
Hi, good morning. First question is belaboring on, your share in the Axis Bank channel. Now, we have about a 69-70% share in that channel. Is there any commitment from Axis Bank that it will not allow our share to fall or below a particular threshold, or is it sort of completely winner takes whatever any insurer can take whatever it wants from that channel. So I'd like to understand if there is any such implicit implied understanding of there in that channel. Second, the margin has done quite well this quarter, and it seems that if your non-par share in the mix continues this way, you'll probably be higher than what you guided for. Your earlier guidance was between 25 and 26% VNB margin. Would you want to sort of change that right now, restate that right now? And lastly, I see your new business strain has increased quite a bit in the first half of this year. I'm guessing this is because of strong sales of these non-par and the individual protection growth also that we're seeing. Is that assessment correct? Those would be my three questions.
I will take the first two, and Amrit will take the last one. On the first one, with respect to counter share, the one part is Axis Bank is our shareholder. We sit together. There are board meetings that take place with very senior officials being in our board. So is it something which is written as a power contract that we have to be 70%? The answer to that is no. But of course, there are some underlying sales assumptions on the and one is of a high belief that we will be able to maintain and Axis Bank will be supported in the counter share. At the same time, the inputs that are required to maintain the counter share, A, product, B, types and quality of resources, C, presence. I think Max Life Insurance will do whatever it takes to maintain that counter share, and over the experience of last many quarters, there is reasonable confidence in the management team as well as at board level that we will be able to sustain. On your question on non-par, yes, the guidance was to be in the range of closer to 26%. But at the same time, what we're witnessing is a much richer product mix. And as a result of that, in this quarter, margin looks reasonably healthy. I think I'm not going to really take a bet on what the margin numbers will be, but I'm very hopeful that through the year we'll be able to maintain a healthy product mix, and hence I remain optimistic about our margin outcomes. On the third one, Amrit, if you want to take that.
So, Madhukar, your observation is correct. Actually, the strain has increased, and the reason for strain increase comes from non-par designs and more specifically annuity designs. So, the annuity with single premium designs where the strain is higher, which gets recognized is the reason why the strain is higher. And within non-par long-term income mix also can cause it. So these are the two reasons why the strain is higher in this.
Just to follow up on that, have we increased any sort of commission payout to any of our partners?
Commissions to specifically to any partner, to our agents, you're always optimizing of how and who is kind of awarding what kind of product mix they're selling. So it's a link factor of what is the variant that you're selling and the product mix that they're selling. So I'm not sure where this question is coming from. The commission structures have remained stable over the years. That if you pick up a particular design, if you sell, let's say, protection regulations allows you to offer 40% commission. So those kind of constructs have always remained.
Right, but and we're probably paying closer to the max that what we are allowed to pay. So it's not the new business strain would not be because of
no. Okay, so if you're linking that with commission increase, no, that is definitely not the case.
That is
not the case.
Okay. So can you throw some color on what sort of expense line items are these?
I said the strain increase is because of reserving requirements of these products. Because you're assuming more risk onto the books, so the reserving requirement of these products is higher. So if I have higher component of annuity in my non-par, the strain will increase. So that's the reason for the increase of strain.
Understood. More because of that than because of actual expenses.
Yeah, the expenses are not the reason for any strain. Yeah.
Understood. Okay. Got it. Thanks.
Thank you. The next question is from the line of Nidhesh Jain from Investec. Please go ahead.
Thanks for the opportunity, sir. Firstly, why we have seen a sharp decline in group term business in Q2? Has there been a change in strategy there?
Sorry, can you just repeat the question? We lost you at our end.
Yeah. So the first question is on group term business. There has been a sharp decline in this quarter YOY. What drove that decline?
Yeah, hi Nidesh. The group term life decline has largely happened because of, you will recall last year was a COVID year, and because these are annual contracts and we were all going through COVID assumptions, the pricing to the corporates were actually much higher. And as the COVID year is behind and mortality has come back, so the pricing to the corporates have reduced. So it's largely coming out of the pricing to the corporates reducing over time, and that's driving this decline.
Sure. Secondly, if I look at the margin expansion YOY for H1 versus last year, the product mix has not materially changed. In fact, I think ULIP share has gone up a bit for H1 this year. So does it mean that the margins on product level has increased? And what has led to that?
Yeah, your observation again is correct. There is some attribution of product mix, but that's far smaller. Largely, it is every line of product. There has been an improvement in margin because of the new product categories that were launched during, you can say, the second half of last year. So whether it is participating design, whether it is protection, where all sorts of repricing actually happens, or whether it is the non-par savings design, all of these have fundamentally gone as structural margin improvement that we have seen for ourselves.
So is it on account of increasing tenure of the product? If you can elaborate, what is the change in product design? That would be helpful.
It has elements of design, and it has elements of tenure as well, and it has elements of pricing to consumer as well.
Sure. And lastly, how the expenses have moved in this quarter or in first half, operating expenses for Max Life, given that we have articulated that we will ramp up the distribution, but I think the expense ratio has improved for the company. So will it be back-ended, or how should we think about expense ratios?
So you would have observed that OPEX actually has increased by 9%. The reason for improvement is the gross written premiums have actually increased higher than the expense increase, and that's happened. But if you see our expense line quarter over quarter, you will see on the quarter two the expense actually have increased to around 19%. And large part of this expense is in line with our stated objective of investing in distribution, whether it is our own branch offices, whether it is our resources in our proprietary channels, or whether it is resources in a non-proprietary channel. So you will see that come in the trend line.
Okay. Thanks, Abdul. Thanks. Thank you.
Thank you. Participants who wishes to ask a question may press star and 1. The next question is from the line of Dhaval from DSP. Please go ahead.
Yeah, hi. Thanks for the opportunity. Prashant, for benefit of all, and if you could just repeat the transaction with Sumitomo as well as the residual stake with Axis Bank, what's the timeline, and in your interpretation, at what price the deal is likely to go through? So your version of it, that would be very useful. Thanks.
Yeah, while we said, we were not going to take questions, but I'll definitely try to give the best shot. We're hoping that after this order which has come from IRDAI, the several reports actually suggested that now we will move ahead and perhaps approval will be forthcoming on the MSI transaction which was filed about a year ago. So I'm very hopeful that over the next few weeks we should have the approval for the MSI transaction, which will be between Max Financial Services and MSI, and that will clean up the overall structure at the operating company level. Subsequent to that, we will file for approval for the balance 7% for Axis Bank, and we are hopeful that we will secure the approval like we secured last time. That is our belief, and we will keep you updated as we go along through the process.
Prashant, any clarity on the pricing of it? I think that there is a lot of debate around it. Anything that you could will it be the same price at which you had agreed previously in both the cases, or is there, so in your version, is there any change that is likely?
I can speak on behalf of the shareholders on Axis Bank as well as Max Financial Services. We are quite committed to moving ahead with the transaction with the methodology that was followed earlier, and that's the approach that we'll take.
Okay. And just last point, in terms of probability of any of these steps, getting delayed beyond this financial year, is there a probability which is reasonably high that some of these steps could get delayed beyond this financial year, or you are very hopeful of completing these steps in the current financial year?
We are sitting in October actually, and I'm very hopeful that the first part of the transaction, which is the MSI transaction, must happen in this financial year. On the second part, even last time it took longer, so it is very hard actually to commit that it will happen this financial year, but it is highly likely that we'll make the application this financial year.
Got it. Thanks, Prashant. Just one last data keeping question. If you could just split the bancassurance AP for the first half, the 1,411 crores, between Axis and other banks, and a similar like-to-like number for the 15-18 crore of last financial year. Just trying to see the performance between Axis and other banks. That would be useful. Thanks.
Individual partner level details, we are refraining from sharing going forward. However, with respect to the degrowth that you have seen, it's similar actually, is how I see it. And largely because of the reason that open architecture scale up is very similar in its timing for us across both the partners.
Got it. Thanks. All the best.
Thank you. The next question is from the line of Neeraj Toshniwal from UBS India. Please go ahead.
Hello. Hi. Wanted to understand, although as you mentioned that there has been some improvement in margin product level in each category, but are we seeing some change in the margin from the first quarter to second quarter between, especially for retail protection, given I think there have been some pricing revision which has happened?
So this is quarter 1 to quarter 2 you're asking, or quarter 2 to quarter 3? Which quarter are you?
Quarter to this quarter, because I think we are taking some price cut in retail protection.
No. So, Neeraj, you would have historically seen Max Life because our methodology of expense allocation is on actual basis or whatever gets spent. And typically quarter 1 is lower on sales volume, and quarter 2 is higher on sales volume, and subsequently the residual quarters also. So there is always this historical improvement that happens. So it's not coming out of any specific changes that are happening in the margin profile of the product or the pricing of the product. I mean, we will tactically keep changing our IRRs, etc., for the non-participating designer products. But over the quarters, the reason largely is on the expense base and the methodology that we follow. And product mix, obviously. Product mix quarter 2, product mix is very different than quarter 1.
And for retail protection specifically, I think some competition has also reduced prices. So does it impact in any way growth going ahead, or it will come at a lower margin? So that is what I want to understand.
Price movements in the industry is part of now a very active way of how you strategically manage your portfolio. And we will take certain calls, but now there are much finer nuances, actually, various cuts of pricing, at various ages, and all of those comes into picture. But nothing in the horizon which between quarter 1 and quarter 2, the margins have remained fairly stable of protection designs.
Got it. And any decision in terms of pricing of a product level driven through the competition at the Axis Bank channel? Because Bajaj have been quite active in terms of be it IRR offering with lower protection pricing. Does it impact in any sense, or it's very short?
Despite that, actually, because counter share is right now, we share and talk about at an aggregate level, but there are finer nuances to counter share. Specifically, you pointed out this question that our competitor has a lower pricing on protection than us. But contrary to your assumption that then our counter share should have been lower, but in fact our counter share is much higher than the average counter share of the 70% that we spoke of on protection design specifically.
Right. So the sustainability is what I was actually pointing out to. So
pricing actually. So our counter share on protection being sold in that channel is higher, despite the fact that our pricing is higher.
Got it.
Any other elements of execution, the trust in the brand, the claims paid ratio position that we hold, and how that gets manifested in the minds of consumers, and then the entire experience process of undergoing a term buying journey.
Sure. And one more question on the non-par, the new product we have launched. So with the expected rise in fixed deposit rates, how actually will this typically short-term saving product will have an impact, or will have a continued strong, because the channels we are targeting is online here, then bank are more proprietary, and I think the 100% more than 100% growth which you talked about is largely online. which is coming through. And so 35% online growth is within proprietary for online. How do we split between savings and protection? That is one, and the future growth outlook on that.
I think I lost you in the question. The question is that FD rate changes that are undergoing, what is the implication on this digital FD product that we have launched? That's
right, that is one, and the growth rates for both online protection and online savings.
Okay. So on the first one, look, FDs are, as an individual investor, you are exposed to the tax element of it. And that way, our offering will always remain superior, tax adjusted. So there is that advantage that we will continue to have with us. So even if the rates move up for FD, but still tax adjusted, our rates will continue to be superior, is how we actually see it sitting inside. On the questions around where is the growth coming from, whether there is a protection growth in online and savings, the question protection actually overall -5%, but for online channel it is flattish. So it's kind of remained. There has been no degrowth. It's around 0% growth. The bulk of the growth in online has come from the savings entry that we have done as a conscious play, which we decided last year.
Okay, and that number would be, if you can quantify?
So the ratio now would be more in the 70% protection, 30% savings.
Okay. Thank you so much, and all the best.
Thank you. Participants who wishes to ask a question may press star and 1. The next question is from the line of Nischint Chawathe from Kotak. Please go ahead.
Hi. Thanks for taking my question. Just one from my side. Do we have a sense in terms of the growth rate by Axis Bank in the first half? I'm not saying for Max, but for the overall bank. I believe last year you had mentioned a number of closer to 25% for the entire year.
So it's Nischint, I think the question you're asking on Axis Bank overall growth. In our estimation, it is single digit, a bit lower than the single digit number, as in a bit lower than the double digit number. So more in the ranges of 7 to 9% kind of numbers.
I believe it was around 25 last year is what you had guided. So anything that you are hearing from Axis as to why is it weak? What is it that they're targeting?
I think it's by the way, it's not just Axis specifically. I think, and Prashant spoke about in his opening remarks, that across the banks, there has been a slowdown with respect to the focus towards life insurance sales, largely because of as the focus towards deposit has increased. Has this happened in the past? Yes, it has happened in the past. But over a longer horizon CAGR, if you try to see, these growth rates are still upwards of 25-30% for our partner bank. And I'm talking about 2-year, 3-year, 4-year, any views that you try to put.
Sure. So my sense is, I think what I'm picking up is that in the near term, it sort of remains a little volatile and kind of nowhere comparable to the 25% that they did last year.
What did you say? The last line?
No, sorry. The point I'm trying to say is that over the next couple of months or in the near term, I mean, in all probably it remains sort of a little weak and nowhere comparable to the 25%ish kind of what they reported last year.
Yeah, I think you should just, Prashant, I think it will be the broader bank ecosystem in terms of their ability or their focus on selling life insurance. I think there is so much push for credit picking up, and that has really propelled the need to have more and more liabilities, which is a trend that we are seeing. And in view of that, maybe for some time we can see that to have some bit of impact on life insurance sales. However, with our bank partners, we are doing a variety of things collectively, starting from new products to incentive changes to RNR, etc., to propel the growth of life insurance.
Perfect. That was my question. Thank you very much and all the best.
Thank you. Ladies and gentlemen, this was the last question for today. I would now like to hand the conference over to the management for closing comments.
Thank you. Thank you, ladies and gentlemen, for being on the Max Financial earning call. We look forward to more such interaction in future, and I wish each one of you a happy and a prosperous Diwali in advance. Thank you, and have a good day.
Thank you. On behalf of Max Financial Services Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.
Thank you.